Welcome to Investment 360. In the hot seat this evening, Risto Ketola, insurance analyst from SBG Securities. Risto, thanks very much. And of course, we've still got Paul Hansen in studio from Sanlam. We're looking at the insurers this evening. Obviously, this is your sweet spot. Let's start with Old Mutual. We've seen a lot of value unlock coming to the table. Julian Roberts really undoing everything that Jim Sutcliffe did, if I can be so bold as to say that. Do you think that's the situation and that Julian Roberts has really got his finger firmly on the pulse, doing all the right things?
Yeah, well, a couple of years ago when Julian took over as the CEO, there was a whole lot of restructuring on senior management incentives where the senior management was actually incentivized to pay down debt to exit the US. So effectively he's doing what he's been paid for. I think part of the thing that the board did when they replaced the CEO was to basically take a new CEO to do what the investors wanted Mutual to do, which was almost shrink back from its global ambitions.
But has it been the right move?
Well, the share price tells you it has, okay? Now, clearly, it's funny, I often joke with my clients saying it's the only company I know that as it shrinks, the market cap gets bigger, you know? So, market likes what they're doing. I think in retrospect also, like US, they left US almost for no exit price. If you look at all the complications of running annuity books in terms of Solvency II, very low interest rates, longevity risk, it probably was the right thing. The group has de-risked massively. That's probably the biggest thing here. Mutual had almost got too big compared to its capital base and its market cap, which meant that you had various divisions that were maybe bigger than the whole, you know what I mean? So problems in US could actually hurt the whole business. And now by shrinking, they're retaining businesses that have low tail risk and are businesses that Mutual can afford to run with a long-term view. So Mutual is definitely doing the right things. Also what's quite important is the recent results. The operating performance was quite good. So you look at sales, they were looking all right, earnings were all right. So quite importantly, they're doing all this restructuring and sort of, let's call it head office level strategy stuff. But the guys running the operations haven't taken the eye off the ball. So that was a concern one or two of my clients had, is that if the only game here is restructure, sell things off, you know, what if the remaining operations go backwards during that time? And it hasn't happened, which is pleasing.
And valuation-wise at this stage, I mean, how would you, it's had a big run.
It's just over 19 Rand, 19 Rand 32. Is there more upside? Perhaps that's what you're asking, Paul.
Yeah, how do you see the valuation now, relative to the others?
It's still our preferred pick. I was here in November, so I think it's worth over 20 Rand. I still think so. I think it's comfortably worth 20 Rand.
It's embedded value?
Yeah. Embedded value now is about 25 Rand, somewhere around there. So it's still trading at the widest discount to embedded value of the South African insurers.
Yeah.
They all trade at discounts to their embedded value.
They do. I mean, Sanlam and Discovery are close to 1x. They trade on small discounts, 4-5%. Then you've got MMI and Liberty trading on about 10% discounts, and then you've got Mutual on about a 22% discount. So even with the run it's had, Mutual's still the cheapest on pure fundamentals.
When you get to 20 Rand, what do you do with it?
You keep it.
You keep
yeah.
it?
No, I think if I look at the pure numbers, my current fair value for the company is about 24, 25 Rand. Now quite often you want to maybe have a 10% buffer for getting things wrong. So, you know, at 20 Rand and 1 cent, I won't sell it. You know, I think at 22, 23, I might start thinking, okay, if there's anything more attractive.
But also, very importantly, this management team has delivered extremely well since they took over. And you've got to go with them. They're delivering the goods so far.
I think there's a lot more to come on the restructuring side as well. So this Nordic deal that really led to the rally in December was a bit left field event. Basically, the policyholders wanted to buy back what had been a Mutual, and it's very fortuitous for Old Mutual and a good price. But you still have a small chance of Nedbank being sold down the line, although Nedbank's performing quite well now. And Old Mutual wants to focus more on Africa, which means Nedbank is a bit more integral to the group again. But you also have the possibility of maybe selling the UK operations. You've got US asset management, which I think is very much available for sale if the right trade buy comes along. So I think you never know when these things will happen, but in the next 12 months, I'll be surprised if there's not at least one more positive catalyst in terms of disposal. So it's got a low valuation, and there's all these, you know, small probabilities every month, but over a year, I would say 1 in 3, 1 in 2 chance of another sale like Nordic, which will lead to another 10-20% ramp up in the share price.
MMI. Results market did not like.
No.
And do you think that it was fair that the stock came off to the extent it did?
I can understand why it came off to the extent it did. So if you look at the results of the insurers, you had very strong results from Sanlam and Liberty. You had what I would call okay results from Old Mutual and Discovery. And then MMI was the outlier. It came with weak sales. Everybody else had very strong sales numbers. It had weak operating profitability, well, flat operating profitability, which is also a little bit behind expectations.
Is it as a result of the merger?
No,
They're in disarray.
I wouldn't blame it on the merger like a lot of other people have. I think these companies both were struggling a little bit on their own. And I think the merger was seen as a way of extracting cost synergies across the two, almost bringing two companies that maybe saw, writing on the wall is the wrong word definitely, but they saw that they were running out of road a little bit. So maybe they thought that through merger they could get best of breed in certain areas like asset management, maybe some cost synergy in areas. They haven't delivered on that front yet.
Should we be a bit more patient, give them some more time?
I think it will take more time, that's for sure.
By competition authorities.
That's right. So what's happening at the moment that if people don't voluntarily leave, they're going to a redeployment pool, so they remain in your payroll. They can start delivering more cost cutting possibly very late this year, sometime next year. But the cost cutting will have to be quite significant. I mean, I think the operating performance in terms of sales and current profitability is so weak that I sort of feel that half the gains on the cost synergies will be needed just to keep the current earnings base going. So I wouldn't get too excited with the synergy benefits. A lot of that is just required to keep the earnings ticking along at single-digit levels.
But it's quite well known that during a merger, the opponents will attack you big time because they know there's going to be a bit of dissension in the ranks and a bit of unhappiness here and there. So your eye's off the ball a bit. So your competition climbs in, goes after your market, grabs. I don't know if that's happened, if they've lost market share. But
do you believe that that's what's happening here?
It takes 2 years.
Yeah, I mean, financial services is tricky. I can't think of many good mergers in financial services in 10 years I've been following it. It looks so easy on paper, but it's hard to deliver. Now, in terms of market shares, I mean, obviously MMI operates across a wide variety of sectors. I think areas that definitely lost market share is right on the top end of the market, where they used to be the strongest of the insurers. So that's sort of like 1 million, 2 million rand lump sum investments. I think a lot of IFAs are going directly to Alan Gray or Investec. Also, Sanlam through its Glacier product line is making inroads there. Asset management, I think they definitely lost some market share. It's hard to measure, obviously, in asset management. The only business where I think they're retaining roughly their relative position is the entry-level life insurance, where Metropolitan Life remains quite a strong player. But there's no doubt that they have lost some market share, be it because of the merger or because they were already struggling a bit before the merger. But the merger certainly hasn't turned around yet.
And putting Joburg and Cape Town together, is that much of an issue?
I think in this particular merger, it's not that bad because the life business of Metropolitan Life is in Cape Town, as you allude to, and the Momentum Life business is in Centurion. Now, those two companies, even though they're called life insurance, they do very different things. Okay, so Momentum is a top-end life insurer. You need to have multiple funds available. Clients want online access. Brokers want to be able to get high service levels. Whereas Metropolitan is simple, funeral plans, simple savings products, requires quite low level of service levels. So there was never going to be any merger of those two back offices anyway. Momentum is too expensive to provide stuff for Metropolitan clients, and Metropolitan actually hasn't got the functionality to provide what Momentum clients want. So where you're getting the merger really is an asset management side, where the number of people required to move is not huge. And then you're also getting the merger benefits quite big on the EB side, where again the teams and the IT is not that extensive that the two locations are a huge problem.
Perhaps we can move on to Sanlam. I'm just cognizant of timing. Where Old Mutual was marked down for going global, Sanlam was rewarded for staying local. It's obviously expensive, and you say close, not trading at such a significant discount to embedded value. But would you still see this as a play in the South African insurance environment?
Well, we have a sell recommendation on Sanlam, so that's a quick answer.
Well, that's a quick answer. Should we move swiftly on?
No. I mean, I think I must just say one or two things there. That Sanlam is a very well-run company. They have a very strong balance sheet. They have really delivered their promises over the years. When Johan van Zyl, when he came there, he sort of had quite a simple strategy of just doing things incrementally better and so on, no transformational deals, and that's worked. I think Sanlam's probably had the best. Discovery might have overtaken it in total returns lately, but Sanlam's had a very good delivery of shareholder returns. But the problem is that you're paying literally 20-30% more on an earnings basis to Liberty, which is another domestic life company. You're paying 20% more than Old Mutual on an embedded value basis. So in a short summary, I just feel that all the good things that Sanlam can deliver to you is already priced in the share price. I mean, after the results, which were, like I said, were strong, I went and I actually looked at my models and I said, okay, let's assume they do a bit better in Africa than I thought. Let's assume they can fix their UK business. They have a small UK business, and I still can't see upside. So I decided to retain my sole recommendation, principally on the basis that if I'm thinking of all the best case scenarios, yet I think there's only single-digit upside, then that's not a good strategy to buy stocks on.
So you wouldn't? Would you recommend Liberty and?
Yeah, our top picks is Old Mutual and Liberty. So Old Mutual is still very much a restructuring story, and it sort of gets affected by global sentiment whenever things happen. Liberty is a more pure domestic story. I think out of the domestic insurers, Liberty is the most attractive.
Have they got their house in order though? This is Liberty.
Yeah, I think there's one big house and there's a few small ones in Liberty. Okay, so the big house is the Liberty Life business that, as me and you know it, and that's where all the problems were 2-3 years ago. That has received a huge amount of management attention, and we saw very good sales volumes, particularly in the traditional top-end market. And we also seen improved persistency. So they are starting to manage to keep clients on their books. A lot of life companies still 3-4 years ago, we spoke about this last time, they were all just focused on sales. And the recession or the crisis almost forced them to actually think about how much money to spend, what to do to retain clients. So what they're seeing now, that even the real economy is still not booming, they're now seeing client behavior in terms of persistency better than in the boom times of the past. Okay, so Liberty has been a beneficiary in that. So I think the big house of Liberty Life is in order. Now what management needs to do is they need to start looking at things like Africa, where they're way behind people like Sanlam to date and to even Mutual. They need to look at possibly, Stanley actually had a surprisingly good year in terms of profitability. Yeah, so Stanley is turning around. Other thing is
congratulations, Paul. You're doing very well.
It's all Paul, must be.
It's all Paul. He's doing incredibly well.
Yeah. The other thing I wanted to mention is obviously entry-level markets. So that's been a good source of growth, particularly for Old Mutual, good source of profit recently for Sanlam. So you look at Liberty, they have huge access to lower income consumers through Standard Bank. But they haven't really had any of their own distribution into lower income consumers, and they want to build that up now. So that's probably the biggest strategic news I got out of the company in the last 6 months, that rather than throwing in the towel, which looked like about a year ago, they're reinvesting again to try and build up a agency distribution to sell to like nurses, policemen, that sort of segment.
Quite highly, Liberty.
I actually do. Now, if you think a couple of years ago, I really felt bad with all those Financial Mail covers with Bruce there losing $1 billion on the hedging. A lot of the current management actually took the business over when there was already a lot of problems there. And they've taken a lot of heat.
So there were legacy issues that they had to step into the hot seat.
Yeah, I think the legacy was very simple, that Liberty for a long time was, let's sell stuff and we worry about the next sale. That was the culture. And in the modern world of having to actually give good advice, making sure the clients get the right product, obviously there's also a lot more competition for clients' pockets. You've got Discovery coming on the risk products in the last decade and so on. They had to change the culture of saying, let's focus as much on client service and value for money as we do on just getting a new client. And I think the current management team has delivered that. It hasn't been an easy job. And the fact that they have fixed the big house of Liberty Life, I must give them credit.
Oh, well said. I like that.
Yeah, I'm talking up your bonus while we're at it.
Yeah, exactly. But no money has exchanged hands here tonight, Risto.
That's what you think.
I've been watching Paul very, very carefully.
Yeah.
Thank you so much for your time. Risto Ketola, insurance analyst from SBG Securities.